Stop looking at the stock ticker for a second. Listen to that sound. That is not the sound of innovation. That is not the sound of the future. As an engineer who has spent half his life in server rooms, I can tell you exactly what that is. That is the sound of $1 trillion being converted into heat. Right now, Silicon Valley is engaged in the largest capital expenditure project in human history. They are pouring concrete, buying copper, and hoarding silicon at a scale that defies logic. The narrative they sell you on CNBC is simple. AI is the new electricity. Buy the stock, get rich. They tell you we are on the brink of a productivity utopia where no one has to work and everyone gets paid. But here is the ugly truth about capitalism that the brochures leave out. Capitalism is a zero-sum game. For every dollar of value created in a speculative bubble, someone else has to pay the bill. When a hyperscaler spends $40,000 on a single H100 GPU, that money doesn't vanish. It transfers. It moves from the shareholders of the buying company to the pockets of the selling company. It moves from the pension funds buying the stock to the insiders selling the top. But what happens when the hardware depreciates? What happens when the grid can't handle the load? What happens when the software becomes a commodity that costs zero? The bill for this AI party is coming due. And I have looked at the numbers. The big tech CEOs aren't paying it. They have golden parachutes. The venture capitalists aren't paying it. They have management fees. You're paying it. Today, we are going to strip away the marketing hype and look at the physics, the thermodynamics, and the brutal economics of the AI infrastructure build-out. We're going to trace the money, follow the energy, and expose the $1 trillion transfer. Welcome to the zero sum. History doesn't repeat, but it rhymes. And right now, the rhythm is deafening. Let's go back to 1845, the United Kingdom, the railway mania. The narrative was identical to today. Trains will change everything. Transportation is the new paradigm. If you don't invest in rail, you'll be left behind. And they were right. Trains did change the world. They revolutionized logistics, travel, and warfare. The technology was real. The utility was undeniable. But here's the part the history books gloss over. The investors got slaughtered. Why? Because of a brutal economic law called the CapEx trap. Hundreds of companies raised billions to lay track. They built parallel lines. They drilled unnecessary tunnels. They competed to build the same infrastructure in the same places. The supply of rail capacity exploded. The price of transport collapsed. When the dust settled, the majority of railway companies went bankrupt. The capital was incinerated. Fast forward to the year 2000. Fiber optics. The internet is the future. True again. Companies like Global Crossing and WorldCom laid enough dark fiber to circle the Earth dozens of times. They spent billions burying glass in the ground, convinced that bandwidth demand would double every 3 months forever. Result? 98% of fiber companies crashed. Who won? The companies that came after. Google, Amazon, Netflix. They bought that bankrupt infrastructure for pennies on the dollar and built empires on top of it. Now look at 2026. We are seeing the exact same pattern. Every major tech company is terrified of being left behind, so they are overbuilding. They are buying chips they can't even install yet. They are building data centers without secured power contracts. This is not a rational investment. This is an arms race. And in an arms race, the only guaranteed winner is the arms dealer. While Microsoft, Google, and Meta burn cash to build the railroad tracks of AI, Jensen Huang is selling them to steel. But for you, the retail investor, the danger is thinking that owning the railroad makes you rich. History says the opposite. The infrastructure builders usually go bust. The value accrues to the society that uses it cheaply, or the monopoly that buys the wreckage. Let's put on the engineer's hat. Because finance people love spreadsheets, but engineers respect physics. And physics is telling us something very different about this AI boom. AI is not software. It is heavy industry. When you query ChatGPT, you aren't just moving bits. You are firing up a massive array of silicon that consumes 10 to 30 times the energy of standard Google search. Training a frontier model like GPT-5 or Gemini Ultra isn't just a coding challenge. It's a thermodynamic event. Let's talk about the specific physics of cooling, something the hype men never mention. Traditional air cooling is dead. The thermal design power of these new chips is pushing 700 watts, 1,000 watts per package. You cannot cool that with fans. You need liquid. You need massive infrastructure upgrades that existing data centers simply cannot handle. This means billions of dollars of existing data center real estate is becoming obsolete overnight. And then there is the hidden hardware bottleneck that nobody is talking about, the high-voltage transformer. You can buy all the GPUs you want, but you cannot plug them into the grid without a step-up transformer. Do you know the current lead time for a utility-grade transformer? It used to be 30 weeks. Now, it is over 150 weeks. That is 3 years. Think about the zero-sum implication of that. If Google buys all the transformers coming off the assembly line for the next 3 years, what happens to the municipal power grid? What happens to the new housing development that needs power? They wait, or they pay a massive premium. The supply chain for electrical infrastructure is breaking under the weight of AI demand, and the cost of fixing it will be passed down to you in the form of infrastructure surcharges on your electric bill. Here is the zero-sum reality of energy. The grid is finite. Transmission lines take a decade to permit and build. But AI data centers need gigawatts now. So what happens? Big tech is bypassing the public grid. They're buying nuclear power plants directly. Look at the deals. Microsoft restarting 3 Mile Island. Amazon buying Talon Energy's nuclear output. This is where the theft happens. When a hyperscaler buys up the baseload power of a region, the remaining supply for homes and small businesses shrinks. Economics 101. When supply shrinks and demand holds steady, prices skyrocket. You're already paying for their AI. Look at your utility bill. Look at the grid modernization fees. They get the pristine 24/7 power to run their training clusters. You get the brownouts and the rate hikes. They are privatizing the energy infrastructure while socializing the cost of grid instability. And it's not just power, it's water. To cool these H100 and Blackwell clusters, you need massive amounts of water. In drought-stricken regions, water rights are a zero-sum game. A gallon used to cool a GPU is a gallon not used for agriculture or drinking. We are effectively exporting our water and energy tables into the cloud to generate tokens that may or may not have economic value. Now, let's talk about the money, specifically the revenue that is supposed to pay for all this. There is a dirty little secret in Silicon Valley right now called round tripping. It works like this. A big tech cloud provider invests $1 billion into an AI startup. The headline says strategic investment. The stock price goes up. But there's a catch. That startup is required to spend that $1 billion on the cloud provider's own GPUs. So the money leaves the tech giant's left pocket, goes to the startup, and comes right back into the tech giant's right pocket as cloud revenue. It's an accounting trick. It creates the illusion of demand. It creates the illusion of growth. But no actual external value is created. It's just money circulating in a closed loop to prop up stock valuations. This is exactly what Enron did. This is exactly what the dot-com companies did. And it never ends well. And let's look deeper at the token economics paradox. This is the fundamental flaw in the business model. The price of computing power per token is crashing. It's a race to the bottom. OpenAI, Anthropic, Google, and Meta are all engaging in a price war to capture market share. They're cutting API prices aggressively. But wait, the cost of the chips is going up. Nvidia is raising prices with every generation. So your input costs, the chips, are skyrocketing, but your output price, the intelligence, is crashing to zero. In any other industry, this is called bankruptcy. In the AI bubble, they call it scaling. They are burning billions of dollars of cash to subsidize cheap intelligence for you, hoping that one day they will have a monopoly and can raise prices. But in an open source world, monopolies are impossible to maintain. If you work in enterprise IT, you know the most terrifying word in the dictionary isn't hack. It's depreciation. In the old days, if you built a factory, that asset lasted 30 or 40 years. In the AI world, your primary asset, the GPU, has a shelf life of 3 to 4 years. Moore's Law is a double-edged sword. It means progress is fast, but it also means your investment rots at record speed. Imagine buying a fleet of Ferraris for a delivery service, knowing that in 3 years, a new model will come out that is 10 times faster and runs on half the fuel. Your fleet becomes worthless overnight. Right now, big tech is holding hundreds of billions of dollars of hardware on their balance sheets. They treat it as an asset. I call it a liability in waiting. As Nvidia releases Blackwell, Rubin, and whatever comes next, the value of the H100 clusters installed today goes to zero. To justify this capital destruction, the AI must generate massive, immediate revenue. It can't just be cool. It has to be profitable. But look at the revenue side. Software is becoming a commodity. Copilots are everywhere. The price of intelligence is racing to the bottom. Open source models like Llama are destroying the moat of proprietary models. Think about it. If Meta releases a model for free that is 95% as good as GPT-4, who is going to pay a premium subscription? The margins for software companies are collapsing. We are moving from a world of SaaS, software as a service, with 80% margins, to a world of model as a utility, where margins look more like electricity companies. But these companies are valued like high-growth tech stocks, not boring utilities. That valuation gap is the bubble. There is a concept in venture capital called the $600 billion hole. That is the gap between the amount of money spent on AI chips and the actual revenue generated by AI software. Right now, that gap is widening, not shrinking. We are building a Ferrari engine and putting it inside a golf cart. The hardware is spectacular, but the use cases, writing emails, generating marketing images, summarizing meetings, are simply not valuable enough to pay back the trillion-dollar investment. And there is one final layer to this zero-sum game: sovereign AI. It's not just companies buying these chips anymore. It is nations. Saudi Arabia, UAE, France, Japan. They're buying tens of thousands of GPUs to build sovereign clouds. Why does this matter to you? Because nation-states don't care about profit. They care about power. They care about security. They are price-insensitive buyers. When a price-insensitive buyer enters the market, it crowds out everyone else. It keeps chip prices artificially high, long after the commercial demand has softened. It ensures that inflation in the tech sector remains sticky. It is government spending, fueled by your tax dollars or national debt, bidding up the price of hardware that creates no immediate economic return. So, let's tally the scorecard. Big tech gets the infrastructure. Nvidia gets the cash. The energy sector gets the demand. The governments get the control. What do you get? You get a slightly smarter chatbot. You get automated spam emails. And you get the bill. You pay it through inflation as energy costs bleed into everything. You pay it through tax subsidies given to data centers to lure them in. You pay it through lower wages as AI is used not to empower you, but to devalue your labor leverage. This is the great wealth transfer. It's a mechanism to convert public resources like energy, water, and labor data into private equity valuation. They are mining your data, training models on your work, running it on power you subsidize, and then selling it back to you as a subscription service. I'm not telling you this to make you despair. I'm telling you this so you don't become the exit liquidity. Wall Street needs you to believe the hype so they can offload their bags before the depreciation bomb hits. In a zero-sum world, you have two choices. First, own the bottleneck. Don't just buy the tech stocks blindly. Look at the physical constraints. Copper, uranium, land with water rights. The things that cannot be printed or generated by code. These are the real assets in a physical world constrained by physics. The AI can write poetry, but it cannot mine copper. It cannot generate electricity without fuel. Second, be the signal. AI generates noise. Infinite noise. We are about to be flooded with AI-generated content, AI-generated spam, AI-generated fraud. In a world of infinite noise, the only thing with value is high-fidelity, human-verified signal. Be the engineer who knows why it works, not the user who just prompts it. Be the one who can fix the machine when it breaks, because trust me, it will break. The $1 trillion transfer is happening. The money is moving. Make sure it's not moving out of your pocket. Do not let the FOMO dictate your financial future. Look at the incentives. Look at the physics. And most importantly, follow the money, not the narrative. I'm the Zero Sum Slayer. I'll see you in the next deep dive. Subscribe. Stay awake.